Good morning, everybody. Thank you for joining us. We're going to get started in just a minute. We're going to give it another minute or two to let some more folks filter in. Thank you. Well, good morning, everyone. Thank you for joining us for our Economic and Markets Update webinar. My name is Andrew Paolillo, and I'm the Director of Member Strategies and Solutions here at the bank. And I'm pleased to have with us today Jason Hwang, who's our Director of Planning and Research. And he does a lot of fantastic work for us here at the bank. And some of you may know him from the Banking Association speaking circuits back when there was a in-person meeting and conference schedule. But we're happy to have him with us here today to walk us through a look at the national and the New England economy and what the implications are for markets going forward. So, at that point, I'm going to pass it over to Jason, and he's going to take it away. Jason.
Thank you very much, Andrew. Good morning, everyone, and welcome to our webinar today. I hope all of you are doing well and staying safe, and I hope we get to do this in person at some point in the near future. I'll provide a brief economic update, as Andrew said, focusing on labor market issues and the GDP, and then I'll ask Andrew to make some remarks regarding interest rates and some market developments. Okay, so labor market, we'll look at GDP, we'll take a look at some New England economy data, and then projections for the next few years. So let's start with the labor market, and I've got some numbers here. Draw your attention to the bottom of the screen of the table where I show the unemployment rate. So September 2020, unemployment rate was 7.9%, which is just almost a half of the peak of almost 15% that we reached in April of 2020. I got some numbers here because I think it's important to understand what's going on in terms of some of the underlying data. If you look at this row, employment or employed individuals, going from February to April, we lost about 25 jobs. About 25 million folks lost jobs in that 2-month period. What happened to those people? Well, 17 million of the 25, 17 million folks became unemployed. So they're shown in the unemployment rate statistic. But a significant number of folks, 8 million folks, were no longer counted as being part of the civilian labor force. So these folks said, I'm not even looking for work. And once you say that, you're not included in unemployment statistic, but you're considered outside the labor force, and that reduces the labor force participation rate. So I want to show these data to make the point that as we track what's happening to the labor market and recovery, we want to be looking at what's happening to unemployment rate, as well as the participation rate. It's great that we've reduced the unemployment rate substantially to 7.9% through September. We've also seen a slight improvement in the participation rate as well, from a low of 60.2% in April. That's improved a little bit to 61.4% through September. And we want to be seeing improvements in both places. Okay. Now, one thing that we want to be looking at is some sectoral distributions of employment, because the job losses, as I'm sure you're all familiar, have been concentrated in a few sectors. So all of the jobs that were lost from February to April, the total number is a little bit different because this is from a different survey than the data that was shown on the previous chart. But of the somewhere between 20 million, 25 million jobs that were lost in that period, a significant portion of it, and just under half of it, was in the leisure and hospitality sector. Food services, restaurants and bars, amusement parks, casinos, hotels, and lodging. So 8 million jobs were lost in that 2-month period earlier in the spring, followed by education and health was the next industry with large job losses. Daycare centers, early childhood education, medical physician offices, a lot of those places laid off folks either on a temporary or permanent basis, so big job losses there. Professional and business services lost over 2 million jobs. A lot of recruiting services put folks on temporary furloughs and so on. And then manufacturing was another sector as well with job losses. Now, retail is interesting. The industries that are shaded here show the largest number of remaining job losses that still need to be recovered. So that's how I chose the 5 rows. But if you look at retail, this one is interesting. Big job losses early on, but we've recovered a lot of that recently, and I'll talk about that in just 1 second. And finally, the industry that has seen significant job losses that have yet to be recovered at all, if you look at big losses in the initial months with hardly any recovery since, is in the government sector. And this is almost entirely driven by the local municipalities. Federal government has added jobs because of the census this year, so they've actually added jobs through temporary hiring of census workers. State governments have not seen big losses in jobs. It's really local towns and cities that are struggling and have done some job losses. Okay, I want to see if I can show us a little bit more data, because as we think about GDP, seeing a little bit more detail here gives us a little sense as to what we might see in the 3rd quarter GDP number when it comes out in 10 days. So starting with leisure and hospitality, again, this is a sector that's seen the greatest number of job losses between February and April. The biggest portion of that was in restaurants and bars. And all of the number of jobs that were lost, we've seen about 60% of that number, 3.3 million jobs, recovered through September. So I would think of this as a relatively healthy recovery. Of course, that means just given how big this sector is in terms of employment, lots of people still are without jobs in that sector, but we've added back a significant portion through September. Amusement parks, casinos, other recreation facilities, we've added back about half of jobs that were lost, but still a way to go there. Lodging, we're struggling more. Hotels and lodging, we've seen bigger job losses and we have not brought those workers back quite as quickly. And so we've only seen 23% of those jobs that have come back to those facilities. What about education and health? And this one is interesting. In terms of contributions to GDP, in terms of national output, this is a very important sector. So interesting to see what's happening here. Social assistance, a lot of the job losses here, were a very significant number, were in daycare centers. And we've brought back about half of those workers to work. The next one is interesting, dentist offices. So a big loss of jobs, but this is one industry that sort of stands out here. We've added back most of those workers. So folks who were, so this suggests that this is most of the folks who were laid off back in March and April were on temporary kind of furloughs. And in the subsequent months, as a lot of the restrictions were relaxed throughout the country, most of those offices opened back up, and those workers are back at work, which is great. If all industries look like this, we'd be talking about a complete V-shaped kind of recovery. But of course, that is not the case for many other sectors. But this is one very positive indicator here, at least for that sector. Education, still a lot slower in terms of recovering those job losses. Early childhood education is a big story there. Physician offices, similar to dentists, they've added back 70% of the job losses in the early months. So a strong recovery there, and hopefully they can get to kind of where dentists are also as well. Now, retail is interesting. Retail, we did see significant job losses, but if you look over here in the previous table, we lost a lot of jobs in retail in February and April, but we actually did really great in the subsequent months. So what happened there? So if you look at these sectors, these are the three sectors within retail that drove the job losses in the early months of the pandemic. And as you can see here, we actually recovered many of those jobs. So clothing, we're at about 2/3 of those jobs are back. Auto parts a little higher, and furniture stores even higher there, or in the 70% range. But can you think of 3 categories of retail where there were no job losses? And in fact, if anything, jobs were added during the pandemic and during all the shelter-in-place restrictions, and they've continued to add jobs since. So those are not shown here, but there are 3 categories of retail. 1, grocery stores. So food consumption for off-premise consumption, those stores have done great because, of course, people are shifting from dining out to cooking at home and eating at home. Second is general merchandise. Walmart and Target have been adding jobs. And the third is construction supplies and home improvement. So Home Depot and Lowe's. Those stores have also done great. So what's happening in those categories are more than offsetting sort of some of the losses and some of the slow recoveries here. And that's giving us a more positive picture, which is why retail is actually not included in one of the top sectors in terms of remaining job losses. Okay, so that's a lot of detail, but I think because of the concentration of job losses, I think it's important to cover a little bit of this detail. So a quick summary. A little over half, about 52% of jobs lost in March and April have been recovered, resulting in September 2020 unemployment rate of 7.9%. I think that is a lower number than many folks were forecasting even a couple of months ago. Remaining job losses are concentrated in leisure and hospitality, education and health, again, mostly in the daycare type facilities, early childhood education, and professional services. And if I look at some local data, for example, for Massachusetts, some layoff notices that came out recently are very much concentrated in leisure, hospitality, food services companies for airlines, and companies that supply food to schools and so on. So those are the companies that are seeing continuing job losses. Surprisingly, retail trade has seen most of job losses recovered due to net job increases in certain sectors like grocery stores, and we just talked about that just now. Now, the thing to note is that the pace of job gains has been faster than projected. So again, folks were projecting a higher unemployment rate even recently. So it's encouraging to see that job gains have been strong, but the pace of job gains has slowed. The very big gains in jobs in June, as most states started their phased reopening plans and folks were brought back to work, but the job gains have been smaller since. So for example, in the month of September, the number of jobs added was much smaller than in the earlier summer months. That has one important implication, which is that most of the big job gains over the summer were employees on temporary furloughs, which means that if you look at folks who are currently unemployed as of October, the proportion of them who are unemployed on a permanent basis is much higher. So folks who were truly on temporary furloughs, they went back to work, many of them did, but there's still a very large fraction of folks who are unemployed, and a higher fraction of them are permanently unemployed, which is a continuing challenge and raises important policy issues as well. Okay, so what's happening? Here's some very recent data. Initial unemployment insurance claims ticked up slightly in October. So we were in the low 800,000 range in terms of number of folks who are filing for the first time unemployment insurance claims. and that increased a little bit in October. So we'll need to watch that carefully and see whether we can maintain that pace of gains on the jobs front going forward. Some uncertainties that still open questions. Are we going to see layoffs after PPP borrowers secure loan forgiveness? Part of the agreement there is that folks keep their payroll and don't do any layoffs during the term of the loan, but once loan forgiveness is secured, will that change? Is one kind of open question there. Will we see layoffs in the airline industry? Big bailout for the industry early on as part of the CARES package, but now that put a moratorium on layoffs through the end of September. So I think things may be changing, and I think we are starting to see some announcements of job losses in that industry. And this is the third point, is kind of perhaps the most important but also obvious point. Until we have a vaccine or treatment that's available and widely available, I think more companies are going to face solvency issues. We went from liquidity challenges early on, but more and more companies will likely face solvency issues. And here are some kind of well-known national brands that have declared filed bankruptcy filings, and we may see more, and that'll certainly lead to job losses. So we'll need to kind of watch what happens there as well. So big question here is whether there'll be kind of a second round of stimulus on the federal level, and what, if anything, that might do to kind of stem these continuing challenges for many companies and job losses going forward. All right, next, let me turn to GDP. So here are some data that show, again, GDP on a detailed industry level for 2019. We can think of that as a very good year, a strong year in terms of labor market and GDP in the low 2% range, which I think is a strong number for the US. And compare that to what happened in the first 2 quarters of the year. And in just a couple of weeks, we'll see third quarter numbers. But what happened here, and let's talk about what we might see in the third quarter report. Okay, the first thing to note, the top row here is the total change in real GDP. So last year we grew at 2.2%. And then we saw an annual rate of 5% decline in the first quarter, and then this very high 33% decline in the second quarter here. Now, as you can see, the next row here is personal consumption. So this is kind of an important point. 2/3 of GDP in normal years, and even in downturns, most of GDP is driven by personal consumption. Personal consumption consists of goods and services are a larger percentage of consumption. So the United States economy is really a services economy, well, we could say. All right, so what drove the recession in the first 2 quarters of the year? And here, there's a kind of surprising thing. I think this is a humbling thing for many economists who study these data, and we don't anticipate things like this. What drove the recession in the first two quarters of the year was healthcare. We have a global pandemic, and if you ask economists, you have a global pandemic led recession. What sector do you think will drive kind of the downturn for the economy? A lot of folks will guess kind of leisure and hospitality, but it's surprising to me that it's really healthcare that drove the economic downturn, explaining 2 percentage points of the 5% percentage point decline in the first quarter, almost half, and then 9.5 percentage points out of a 33% decline, which is almost a third in the second quarter. So really, healthcare really drove that big decline in national output. Why is that? Well, because some healthcare outlets were closed altogether, like dentist offices, some physician offices, and hospitals. Many procedures that were scheduled and would have taken place were deferred. And a lot of output and income in the industry is elective procedures. And as those were delayed until later in the year, there was a big drop in national income and output. So this to me is a promising sign in terms of thinking about the third quarter, because as we saw earlier, dentist offices are open and most folks there are back at work. That's an encouraging sign. So output from that sector will contribute to a very positive, I think, a fairly strong number here in the positive direction here. And as folks return to hospitals for elective procedures also, this should also make a positive contribution to GDP as well. So that's an important sector to watch. Now, the food services and accommodation and recreation services, in normal years, those are relatively small sectors in terms of contributions to GDP. They hire a lot of people, and many folks rely on these industries for their livelihoods, but income tends to be low. So contributions to GDP tend to be lower, but because there was a complete shutdown, the decline explained a very significant portions of the declines in GDP, especially in the second quarter here. So as we've seen in the employment data, again, no full recovery by any stretch, but something like 40%, 50%, maybe even a little bit more of the workers are back. Doesn't mean that the sales are where they were before, but again, we've seen some recovery, so we should still see a rebound here of some magnitude. Unclear exactly how big, but we should see a rebound there. So I think all three of these sectors should lead to a positive GDP rebound in a positive direction. Okay, so GDP numbers, they're not out yet, but we do have monthly sales data in some sectors. And so we can kind of look at that and see what that might tell us, because this is sort of an early indicator of what we might see in GDP. So this is retail and food services. And as we can see here, a big drop in March and April, and also a pretty sharp rebound in sales. So this is kind of one small portion of overall consumption, but promising in terms of what we might see here in terms of overall consumption. The next one is an important one. This is automobile sales. So I look at this in most of my presentations because durable goods like household appliances and cars are the thing that responds very sensitively to economic outlook. When folks are very concerned about jobs outlook and what might happen to their income, one of the first things that folks do is to defer purchases of big ticket household items like appliances as well and cars. So where are we now? We did see this big drop off in April, of course, when a lot of car dealerships were not open, but we've seen a big recovery since then, almost getting us to the point where we were before the pandemic, around 17 million cars sold at an annual rate, and we're kind of approaching that level. So that's also kind of an encouraging sign that durable goods consumption is returning to kind of where it was before all the restrictions went into effect. Here's kind of the one very positive spot in terms of consumption, which is building materials and supplies. So we're talking on a retail level, Home Depots and Lowe's of the world. And as you can see here, in March and April, not much of a drop. If anything, we were seeing a bit of an increase here. And then over the summer months, sort of a fairly big increase in sales from those types of stores. I guess a lot of folks doing both DIY projects and then maybe some deferred larger projects that didn't happen early on in the early part of the year are now taking place. So that's giving a significant boost to consumption in this area. So having seen all that, what are economists thinking for third quarter GDP? So this is a model that comes out of the Atlanta Federal Reserve Bank. So the green line is an estimate based on a model. I wouldn't put too much stock in any model right now, because I think given the extreme volatility and very unusual nature of what's happening, I don't know that there's any model that can capture what's going on. But here's one model that's projecting a very strong GDP number, something like a 35% increase in the third quarter. But also if you look at this blue line, that's the blue chip consensus based on projections from a number of leading forecasting firms and economists. And their consensus is that we should see something like a 30% recovery, positive GDP number in the third quarter as well. So these projections, both model-based as well as a survey of economists, are telling us that we may see a very strong third quarter GDP number in a couple of weeks. Let me turn now to New England. Okay, so employment status in the 6 New England states here. And as I mentioned earlier, important to focus on both participation rates and unemployment rates. So couple of observations. If you look at the details, our job losses in New England are led by the same sectors. Not surprising, leisure and hospitality, retail trade, education and health are the sectors where folks have suffered the largest number of job losses. Now, looking at unemployment rates, as you can see here, I mean, hard to imagine. Back in March, we had these types of unemployment rate numbers, which were amazing numbers, right? New Hampshire at 2.4, Massachusetts 2.8. These were almost historically low unemployment rates, very tight labor market. Hopefully we get there again, who knows when. But as of August, which is the most recent data point I have, Massachusetts is at 11.3. And then there's a range here. Some states are doing better. Maine looks a little better in terms of unemployment. And there, I think a lot of the restrictions were not as strong. The COVID situation was much better in Maine than elsewhere in the country. And then there's a range from 7% unemployment in Maine to 11.3 in both Massachusetts and Rhode Island unemployment. In terms of participation rates, we do see here that we got a long ways to go here, because we did see a big decline in participation rates across all states. We were in the 65, 66, 68 range, a little lower in Maine because of the demographics there. And then those numbers are substantially down. So not only do we need to make more progress on unemployment, and our unemployment rate is elevated compared to the national rate, but we also have much more ground to make up in terms of folks returning to work altogether, because these are folks who have left the labor force, and we want them to come back to the labor force for a full employment, kind of healthy labor market. Okay, interesting factoid, in June and July, so this is August data, but in June and July, Massachusetts had the highest unemployment rate in the US. And I saw that data and I was very surprised, not something that I would have expected for Massachusetts at all, but that was due to a slow recovery in the leisure and hospitality and retail sectors. And I think a lot of that had to do with the stronger restrictions on those businesses reopening and the phased approach, which was slower in Massachusetts than elsewhere in the country. But since then, we are kind of catching up, and we brought back unemployment rate down to 11.3, and I suspect that we'll continue to see the number come down in subsequent months. Now, there is one thing that perhaps worries me a little bit, is that looking at Massachusetts, this is weekly data showing us initial claims, so initial unemployment insurance claims. And so, of course, we saw this huge spike in folks filing for unemployment insurance, and that number has been declining, basically starting in April. After that spike has declined all through the summer. We hit a bit of a plateau, and then in September and the early weeks of October, we're seeing a bit of an uptick here in terms of folks who are experiencing job losses and filing for unemployment insurance. So this is definitely important to watch, and I really hope that this pattern reverses. But if this pattern continues, this is going to represent obviously a lot of hardship for folks who are unemployed, but also as we kind of enter the fall winter season, and there might be perhaps a return to more restrictions on travel and businesses and so on, that if that does happen, that could really complicate this picture here and lead us to deterioration in the labor market outcomes. Here are some data, finally, on some recovery indicators. I've looked at this to see what's happening in terms of specific data that are specific to Massachusetts and the Boston area. So I look at three things here. So the first is a number of passengers going through TSA checkpoints. So on the top row is the United States, and these are all year-over-year changes, which means that in the top row, the US, January numbers are strong compared to last year. We're up a little bit. More folks were traveling domestically, internationally. But then, of course, in April, the year-over change was almost 100%. Nobody was traveling by airplane. And then by August, we had recovered So again, this is nowhere near where we were last year, but we were down 70% compared to August of last year, which is much better than being down almost 100%. And then by October, we're down 65%. If you look at the Boston Logan Airport, air traffic was down almost 100% in April, similar to the rest of the nation. And we had recovered a little, but not nearly as much as the rest of the country had as of August. We were at somewhere between 80% and 90% down. Still, so not many people traveling, going through the Logan Airport compared to the rest of the country. I don't have data for October yet, but this, as you can see here, this tells me a little bit that we're lagging the rest of the U.S. in terms of recovering in areas like travel, and that would have, I would expect, downward effects on lodging and other destinations, travel destinations in the state as well. Highway traffic. So here are three sort of places where the Massachusetts Department of Transportation keeps track of how much traffic we have. So again, year over year, in January, numbers are strong, either a little bit down compared to 2019, up. In other places, traffic was down substantially, had recovered significantly by August. So folks were still traveling near the Cape. Traffic was where it was last year, so that's a good thing, but still down elsewhere as well. And I think if you look at similar traffic numbers, I don't have the specific data for the US, but elsewhere in the country, I think these numbers look stronger also. So we may be lagging there as well. Reservations at restaurants. So for the US, again, year over year numbers, US has recovered to being about down half of reservations that we saw last year. And Massachusetts is similar, about down 50%. And then in the city of Boston, the numbers look a little worse. But by October, we've seen a further recovery in the US. But again, Massachusetts and Boston, we are lagging a little bit, the pace of national recovery there. Okay, so those are some additional color to give us a sense of how fast the recovery is going in our region. Let me conclude now with some projections for the national economy on different metrics for the balance of 2020 and 2021 and 2022. So real GDP growth. So it seems that a lot of folks are expecting a fairly strong rebound in GDP. So at an annual rate, once all is said and done, so this is incorporating third quarter and fourth quarter rebound for the year as a whole, folks are expecting about a 4% decline in GDP. And interestingly, we're expecting about a 4% increase in 2021. Now, I've been giving these presentations over the summer. And when I had this table back in June, based on June forecasts from the FOMC, from a Wall Street Journal survey of economists, the numbers did not look like this. We were projecting a much higher decline in 2020 GDP and a slower rebound in 2021. So if you asked folks, when do you think we'll return to pre-pandemic GDP, let's say fourth quarter of 2019, folks were saying things like, we'll get there maybe in 2023 or later. But if you take these numbers and just do a calculation, it says that we're now thinking that GDP might return to pre-pandemic levels by the end of 2021, about a year from now, or early 2022. So the pace of recovery is now projected a little bit faster. Unemployment rates, we're now thinking that the year-end unemployment rates might be in the 7%, between 7 and 8% at the end of this year, and then somewhere between 5% and 6% at the end of next year, and then in 4 to 5% range the following year. And again, these are very up-to-date forecasts from either this month or a few weeks ago in September. And these numbers look much better than what folks were projecting back in June. Some folks were saying then that we're not going to see a single-digit unemployment rate sometime until the second half of 2021 and things like that. And so things have improved at a faster rate. Now, that is all great, but I would caveat all of that to note that the pace of improvement has slowed substantially. So it's not clear to me. We don't want to put too much confidence in the pace of recovery just based on what we've seen over the summer only, because the pace has slowed substantially. Fed funds rate projected to be near zero. This is consistent with some recent announcements from Chair Powell, who's saying that the FOMC is going to change their view on inflation, and they're going to tolerate some period of higher than and target inflation to maximize employment. So that says that they're going to keep their rates lower, maybe longer. Some people think as long as 5 years. I don't think anybody knows, because they're going to tolerate a some period of above 2% inflation, and that likely means that we're going to be seeing an extended period of zero rate policy rate. Okay, and then 10-year rates projected to be continuing in the 60, 70, 80 basis point range, and then a slight increase in the next 2 years. Inflation, no one's really expecting any kind of inflation problem in the next 2-3 years. It'll be interesting longer term, just given the amount of debt that the federal government is accumulating this year and probably going into next year. What that might do in terms of outlook on inflation, how the government intends to sort of pay for all that debt. That'll be interesting, sort of as a longer term matter. Home price appreciation, this is another interesting area where the projections have changed. When we looked at this back in June, both Fannie Mae and the economists were projecting a much lower rate, closer to zero, appreciation in 2020. That's now changed. I think we've seen stronger price improvements more recently, and we're expecting a healthier increase in home prices this year, followed by a slightly slower, but still reasonably healthy rates of appreciation in 2021. That concludes my presentation. I would just conclude all of that to say that everything depends on the rate, on the path of COVID. I think huge amount of uncertainty here in terms of infection rates and so on. So everything depends on the timing of vaccines. The other thing that will impact all of the metrics is whether we see a second round of federal stimulus. I was fairly confident just because I thought it was in everyone's interest to get something done earlier, but we still haven't, it hasn't happened yet. And so we'll see if there's any successful negotiation on for the stimulus, and that'll impact things as well. I will conclude there and turn things over to Andrew.
Thank you, Jason. That was fantastic. And, you know, we certainly are in uncharted waters here, and there's an awful lot of uncertainty as to the pace and magnitude of the recovery. So what I'd like to do now is take a look at what's going on with the yield curve on member balance sheets in certain pockets of the credit markets and how they're tackling with that uncertainty. So the first thing that we can look at is two metrics that we can use to gauge the systemic health and the expectations that are being priced in. So on the left-hand side here, we see the spread between 3-month LIBOR and 3-month classic rate. So this is a cousin to, if you're familiar with the TED spread, which looks at LIBOR versus T-bills. Excuse me. And this is simply a measure of credit stress in the funding markets. And as we can see, looking at the path of that spread, it's been low and very stable and hovering right around the minimum level that we saw back in 2019, which is where it's been cruising for the better part of 4, 5, 6 months, you know, coming out of the height of the pandemic. So, you know, the long and the short of it is the market is receiving more liquidity than they need right now. The other thing that we want to look at is interest rate volatility, and you know, that's a very complex and varied calculation. But one way that we can get a proxy for that is looking at a combination of advanced products. So we have our member option advance and our classic advance. And that spread, much like funding stress, volatility has been coming down. And part of that is attributable to the Fed using communication as a policy tool more than they have in the past. So when you think about how prevalent they have been in quantitative easing and purchasing mortgage-backed securities, that removes volatility from the market. But because we are at the low end of Fed funds rates, and they've been very transparent in signaling that there's no expectations for hikes out to 23, and as Jason alluded to, being willing to let inflation run, that has given the market greater levels of transparency and removing volatility. So, putting aside the calculations, just looking at the election, again, the uncharted waters we are with this pandemic and the pace of a potential vaccine, those are potential catalysts for volatility. And when there's dislocations, that potentially creates opportunities. So if we move to the next slide, this gives us a perspective on what's going on the asset side of the balance sheet. And despite all the stability and lack of volatility on the funding side, the story has been different on the asset side. That when you think about financial institutions driving return from either the slope of the yield curve or credit spread income, those spreads and those sources of return have been coming down pretty sharply. So here we have the Fed funds versus the 5-year Treasury, as well as BBB corporate bond spread. So that can be a proxy for depositories on the lending side. So one thing to point out here is this: despite the low level of rates, the minimal amounts of steepness, that there have been little pockets, namely back in May and towards the end of August, and we're seeing it now again in October, where the intermediate and long end of the curve does start to creep up a little bit. So in those first few months in March, April, May, there was a little bit of a shell shock in terms of where rates are and kind of digesting this new world that we're living in. But there have been opportunities to incrementally add a little bit more yield, either through the yield curve or even in credit spreads. And one thing I'll point out on the credit side, we have been hearing more and more from members that the largest, highest quality commercial borrowers have really been flexing their muscles in terms of looking to refinance and take advantage of the opportunities to refinance. So some measure of proactive customer engagement there, will help keep those loans at your institution. And on the fixed income side, a similar pattern has occurred in terms of the up in quality. So the higher credit quality, whether you're talking about the corporate markets or the securitized markets, there has been a shift, and the demand has wildly outstripped supply over there. So as we talk about all this uncertainty that is in the markets, how are balance sheets responding to that? And the thing that jumps off the page is the amount of cash that is still on depository balance sheets. So we're a week and a half out from 9:30 call reports coming due, but we do have an intermittent look from the weekly aggregated data that's available from the Federal Reserve. And what we see is that we're at post-pandemic highs in terms of cash as a percentage of assets. And despite things that starting to tick down over the summer, it has been creeping up. And that is consistent with what we've been hearing from members, and also through the consultant community, the ALM folks and the broker dealers, in that it's coming from both sides. It's the challenge in deploying assets, but it's also the deposits continue to keep flooding in. And now that we have PPP forgiveness on the horizon, that is only going to add to the cash build. And so when we talk about how do we normalize cash levels, there's really three things that jump out to us. Is retaining fixed rate mortgages, and that checks off a number of boxes right now in terms of wider historical spreads. The volume is there, something that maybe you can't say for the commercial side of things, and also there's been many instances of greater asset sensitivity, greater capacity to take on these longer duration assets. The second thing would be to recalibrate the investment expectations, right? If you can't lend it out, you park it in investments, and I get it. It's challenging, and looking and seeing what you have to do to get to 1% in terms of duration risk or premium risk. But this is the new world that we're living in, and the the ability to find out how much risk you can take and where you want to be on the curve and produce that cash flow for, as Jason pointed out, when we do begin to see some normalization over the next 6, 12, 24 months, to have that incremental income now, but cash flow coming due at that time. And then the other area would be to pull every lever that you can in terms of pricing the deposit portfolio. So we have this significant mismatch between the prospects for the asset side and the liability side. So look at where you have incremental funds available to you via advances at 30, 40, 50 basis points at whatever point of the curve you want to be. So when you look at the prices that you're paying on the various deposit products, and if you are sitting in a position of significant excess liquidity, then there has to be some justification for paying prices above the incremental funding costs from advances. So the big thing is getting liquidity back to a normalized state. So if you're able to pull some of the levers that get you closer to that normal operating range, as we alluded to, there are opportunities where the funding side can come into play. And we've talked about some of these things, and I'll point out two in particular that jump off the page, is that 12 to 18 month part of the yield curve where it's either flat or inverted to the short-term rates. And being flat or inverted at 40 basis points is different than being flat or inverted at 240. So you don't give up some of those potential repricing benefits in a down rate environment because we are already so low. And the other one that is worth pointing out is the SOFR index advance. So I'm a big believer in don't fight the Fed, and we see the transparency and the communication from the Fed that Fed funds are not going to rise for a number of years. So pricing off of an overnight index is consistent with that and tethers you to that. But there is some value in extending the average life where you get the stability and you can avoid any potential spread hiccups by having the longer average life, but having the rate determined by what's going on at the overnight part of the curve. So we'll wrap things up by just pointing out that we have been putting out a number of different types of content and resources available. They're all on our website, and they go into a little more detail of some of the things that we've talked about. I will point out tomorrow that we are hosting the virtual member open house. So it's the registration link, if you're not already signed up, is on the website and also in the daily rate email. So that's a good event where you get a chance to learn a little bit more about the bank and hear from a number of folks. So if you have the time and inclination, I'd invite you to visit that. So at this point, we'll wrap things up, and I want to say thank you to Jason for joining us today and walking us through that look at what's going on in the economy. And thank you everyone for joining us. And if you have any questions, we're always happy to have a discussion. Feel free to reach us out, and we're here to help in whatever way that we can. Thank you very much, and have a great rest of your day.